Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. Happy Wednesday. These are the stories that set your agenda. The global rally stalls as Nvidia leads a tech stock sell-off. Investors look ahead to Jerome Powell's Jackson Hole speech on Friday. Focusing on the future, Europe weighs sending troops to Ukraine as part of a peace agreement, while Switzerland says it will offer Vladimir Putin immunity if it hosts talks on ending the war. Plus, UK inflation in focus, with data today expected to show CPI ticking higher, keeping the Bank of England on edge. Let's check in on the markets then. The tech sell-off is the market story of the moment. Nvidia central to that, of course, dropping 3.5% in the session yesterday, dragging on the Nasdaq 100, which closed lower by 1.4%. And the futures are suggesting there's going to be further selling pressure in the session today as well. Is this profit taking? Is it positioning ahead of Jay Powell? Or is it a concern about valuations? Or possibly a mix of all of those factors? Nasdaq 100 futures right now pointing low by 123 points, looking to further sell off by 0.5%. On the S&P 500, you're looking at a drop possibly of 20 points. Before we get there, of course, European futures, after a decent session yesterday, despite the pressure on defence stocks, ending the day up more than 0.6% today, looking to erase those gains, pointing lower by 0.7% on the European Stocks 50 futures. Here in the UK, FTSE 100 futures currently pointing lower by around 15 points. The inflation data, of course, will be central in terms of thinking around the BOE, dropping at 7 a.m. UK time. Let's flip the board and have a look cross-asset. The pound then in focus for us today. Markets, of course, have paired all those bets around the BOE and additional cuts coming through in 2025 for the rest of the year. Those have been faded by the market. 134 right now on the pound. We'll see to what extent that adjusts around an inflation print expected to come in. Headline year on year for July, 3.7%. The pound currently a little softer by 0.1%. The dollar, though, 3 straight days of gains. 4.30 run right now on the benchmark US 10-year, largely unchanged. Stability in the Treasury markets in the session today. Brent at $66 a barrel, up 0.3 on oil. And gold also getting a modest lift after a bit of pressure in the last few days on the yellow metal, currently up 0.1%. So the tech sell-off continuing into the Asian session. SoftBank is a big part of that story. Let's get more from Paul Dobson, Bloomberg's executive editor for Asia markets. Bring us up to speed then in terms of the read across from the sell-off on tech in US into the Asian session, Paul.
Yeah, well, obviously, Asia's markets are pretty tech-heavy in terms of the gauges that we have here. And yes, we're starting to feel that follow through, particularly in South Korea, which is having a bit of a miserable week, but also in the Japanese tech sector. And, of course, industry leader TSMC over in Taiwan also taking on the nose, much as Nvidia did in the US session. I think the SoftBank one is interesting. That's it also has a sort of parallel in the US, right? It's absolutely been flying higher in recent sessions, been on an absolute tear, and, you know, a little bit like a shooting star, it's now starting to fall back out of the sky. A lot like Palantir has been doing in the US, up over 100% year to date, but the last 5 sessions have been negative and starting to get a little bit more heavy as well. So I think that tells you that there is that sense that some of the most favorite stocks people are starting to take some money out of. There are a bunch of reasons to be cautious there, and definitely valuations and momentum are a couple.
OK, valuations and momentum. Paul, what is the assessment of you and the team in terms of what the catalyst was, if there was one, for the sell-off that we saw yesterday in terms of tech, US mega cap tech, the pressure on companies like Nvidia, at least the stock, their earnings are out next week. Was there one thing that stood out to you and the team, or is it a collection of factors?
No, I don't think one thing, Tom, but I've been crowdsourcing the best answer to this question all morning. And I figured that there's several different things that are starting to accumulate that are getting people worried. First of all, obviously, we have the Powell speech at the end of the week. If he's not as dovish as the market would like to see, that would lift up yields and that would be negative for the tech sector, for one thing. Plus, if the Fed's not actually going to cut, then that's not great news for equities either. So I think that you have that weighing on people's minds. I think that you definitely have the momentum starting to falter. Volatility had drifted lower and lower and lower, so we were kind of teetering in a search of a new direction. So maybe down makes sense, particularly as this has been such a well-chased rally with the likes of CTAs, momentum following funds jumping on that bandwagon as well. So there's a few reasons there. There's also interesting things like seasonality factor. Retail traders in the US have been very active all the way over the summer period. This is the time of year when they start to drop out of the market a little bit, according to some research that's out there. And that would be interesting, if they're not doing those day options, pushing the market ever higher, then maybe that takes some of the momentum out of there as well. I think there's one other factor as well, which is a better news thing, right? Everybody has been so worried about how concentrated the gains in the S&P have been this year, how it really has been the Magnificent Seven leading the charge. We've seen a bit of better news in the rest of the market recently. So while we had that sell-off in tech, 350 out of the 500 companies in the S&P index were up yesterday. So not all bad news. Maybe we're seeing a little bit of a spread out into some of the weaker and undervalued parts of the market as well.
OK, that's good nuance to that concern about the lack of breadth in the market stateside, in the S&P 500. We're seeing a bit of a change to that narrative yesterday. Paul Dobson, excellent, thank you. Bloomberg's executive editor for Asia markets. Let's get more market analysis and bring in, of course, Valerie Teitel right now. With Jerome Powell and Jackson Hole, that speech on Friday, Val, to what extent could we be seeing some repositioning on possibly caution around what Jay Powell may end up saying at the end of this week?
Yeah, yesterday's tech sell-off could be tagged to the fact that people are just taking off favored positions, crowded positions ahead of the biggest risk event of the week. Amongst these illiquid markets, we could see quite a jolt to the market. The question really is, Tom, what kind of pivot are we going to get from Fed Chair Jerome Powell? Is it going to be the dovish one that the market wants? Is he going to signal that the labor market has weakened, opening the door for a September rate cut and maybe a few more to follow? Or is he going to sound hawkish? This is a very interesting point made by our own U.S. economist Anna Wang overnight. I highly urge you to read her note on the terminal. She thinks that the Powell is going to come out hawkish and drop this framework that's been called the flexible average inflation targeting. Now, this kind of monetary framework allows the Fed to look through inflation being off target because they simply project it falling back to target. It was a very useful framework, Tom, when inflation was consistently missing to the downside, gave them a reason not to continue easing, but it's complicating the matters now with inflation above target. That could be a very subtle hawkish signal from the Fed chair. Or is he going to signal neither hawkish nor dovish? Maybe he could stress data dependence. We do have another NFP and another CPI before the Fed convenes on September 17th. So those are the kind of scenarios the market is penciling through. But take a look at what the market's done ever since that weak payroll print. When it comes to that 2-year yield, that rally has really contained. But since that hot PPI, we have continued to drift up just slightly, putting that September cut in doubt. We're now sitting around an 85% chance of that Fed cut in September. The market, though, is thinking this is a good risk reward and is adding to options in SOFR futures and front-end rates, betting on a major 50 basis point cut in that September meeting. So we are seeing a bit of two-way price action when it comes to how we're positioning. But take a look at what the political pressure has been looking like, Tom. The Fed is under substantial pressure. Still a lot of questions on how it's going to react in this next meeting to the substantial pressure from all over the Trump administration. A recent Truth Social out from the president saying that there is every sign pointing to a major rate cut. So we know where the administration stands. They look like they want a 50 basis point cut in September.
Yeah, brace yourself if we get a hawkish set of lines and a statement from Jay Powell, or a speech at least on Friday then, in terms of what the Trump administration and how President Trump himself may respond to any hawkish tilt from Jay Powell, if indeed that's what we get. The risk event of the week. Bloomberg's Valerie Teitel, thank you very much indeed. To geopolitics, of course, a focus on what is transpiring around Ukraine and Russia. A package of security guarantees for Ukraine is now taking shape, with European leaders weighing sending troops as part of a potential peace deal. Ukraine's allies are hoping to strengthen Kyiv's position ahead of a potential meeting between Presidents Putin and Zelensky. US Special Envoy Steve Witkoff spoke to Fox News on US efforts to broker that peace deal.
It's our job to bring the parties together, to narrow the issues, and that's what President Trump does better than anybody. He's got a real sense. I mean, he's got a real sense of what it's going to take for Ukraine to meet in the middle and to move the Russians.
For more, let's bring in Bloomberg's Ros Matheson. Ros, do we have more details now in terms of what the shape, the nature of these security guarantees could look like?
What our reporting is showing is that there would be several stages potentially of these security guarantees. And the first one is simply to bolster Ukraine's troops and to bolster their training and to make sure that weapons are still flowing to Ukraine, and possibly backing that up by having troops from the UK, France, other countries in Europe inside Ukraine, helping with training and support, obviously quite some way from any kind of front line, but operating on the ground inside Ukraine. And that could number troops in their hundreds. But the key role here really would be for the US. What does Donald Trump mean when he talks about security guarantees, when his senior officials say the US is willing to be part of that? Because what Donald Trump is saying changes on a daily basis there. At some point, he even said, do they actually need to give security guarantees to Ukraine? But it does sound as though the US is talking with Europe, with Ukraine, about things like intelligence sharing, making sure that's still going on, ways to ensure that weapons are still going to Ukraine, possibly providing air support, air cover for Ukraine. And that's something Ukraine had asked for earlier in the war. They wanted an air defense zone set up to help patrol the skies over parts of Ukraine. And NATO and the US said no. Is that now on the table? But that does seem to be quite some way down the track. At the start, it seems like a lot of these guarantees are simply about bolstering the existing level of weaponry and training for Ukrainian troops.
And Ros, do we have any more clarity as we look at the additional details around the security guarantees? Any more clarity as to when or even if this meeting between Putin and Zelensky will actually happen?
Well, it's certainly momentum seems to be towards finding a way to make this meeting happen. The Ukrainian leader says he's ready for it. Vladimir Putin, perhaps slightly more cautious on it, but at least reading the room, no doubt, on what Donald Trump wants here. So perhaps we'll agree to a meeting, but that's the bit that's a little bit less certain, is whether Vladimir Putin is actually eager to do so. And then when? Is it a matter of weeks? Is Putin going to drag the chain for longer on that? Because he's been very adroit at dragging the chain through this war in terms of getting towards a ceasefire. So does he drag this out? And then location. We're hearing, of course, the Swiss are saying they would give Vladimir Putin immunity if he flew in there and they hosted a meeting. We're also hearing that Budapest might be an option, that Hungary might say that they could be the venue for that, although they've been quite antagonistic towards Ukraine in this war. So perhaps Zelensky won't want to go there. Is it somewhere in the Middle East? It has to be really kind of a neutral setting for both leaders if they're going to go there. The question is maybe less location, but more timing. When is this meeting going to happen? Is it going to happen, as you say? Or is Vladimir Putin going to simply try and drag this out for longer?
OK, Ros Matheson, Bloomberg's chief Asia correspondent, in terms of the additional details that we've been getting on progress towards a potential peace deal, with serious questions that still remain, of course, and potential locations for that meeting between the presidents of Russia and Ukraine. Switching focus right now to the earnings story, with focus on Mart, listed in Hong Kong, of course. The stock is up more than 230% year to date. The maker of these Labubu toys that have somehow become a huge phenomenon. And the lines in terms of what we've been seeing from Mart on the back of this, the stock is jumping. They came through with some earnings that beat. And the headline from the latest Bloomberg story is this: Mart shares rise to a record as the CEO announces a new mini Labubu. So all those fans out there of the Labubu, you can rejoice. These are priced at about £64 on the website, at least some of the previous ones. The Labubu Time to Chill vinyl plush doll can be yours for just £64. This has been a phenomenon that has, of course, propelled the stock up more than 230%, now at a record high. A check on Mart for you. Here's what else to think about today. 7 a.m. UK time. Inflation data out of the UK for July as markets fade those bets around additional Bank of England cuts. Will the price data today change that narrative? We'll break it down for you, of course. And before the market, target earnings, another gauge on the health of the US consumer. And at 7 p.m. UK time, we'll get those FOMC minutes. So more colour in terms of how Fed officials are thinking about the path ahead as that debate around September remains and the build-up to Jackson Hole and Jay Powell's speech. You can get a round-up, of course, of the stories you need to know to get your day going in today's edition of Daybreak. Terminal subscribers can go to DayB Go or DAYB Go on the terminal. And front and centre is a focus, of course, on the sell-off around tech and what has triggered that. Coming up, US Treasury Secretary Scott Bessent escalates his criticism of India over its purchases of Russian oil. We will have more on India's response to that pressure. Plus, later in the programme, we will look ahead to the UK inflation data out in just under an hour. I'll be joined by Bank of America's UK economist. Stay with us for that conversation. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. US Treasury Secretary Scott Bessent has indicated that the US is satisfied with the current tariff arrangements with China. When asked in a Fox News interview when progress in negotiations would be seen, Bessent said that, quote, "We're very happy with the tariff situation with China." He added that he thought the status quo is working pretty well. Separately, Bessent escalated criticism of India over its purchases of Russian oil, saying India was, quote, profiteering from the oil purchases.
They're doing what I call the Indian arbitrage. They're buying cheap Russian oil, selling petrochemicals back out. Much of that is going to the richest families in India. We already have very high tariffs on China, and now India is going to see what it feels like.
For more, let's bring in Bloomberg's chief North Asia correspondent, Stephen Engel. Steve, it's pretty fascinating to see a Trump administration going a little softer on China, but ramping up the pressure on India. What else stood out to you in terms of what we've been hearing from the US Treasury Secretary?
Yeah, there's a lot to unpack there, and essentially Scott Bessent giving the justification for increasing those tariffs on India from the 25 reciprocal to 50, so an added 25% because of India buying that cheaper Russian oil, which Scott Bessent says, as you just heard, they're taking it, refining it, and on-selling it to the tune of some $16 billion, profiteering, or the words that he used, to the benefit of the big conglomerates. You don't necessarily have to be naming, he doesn't have to be naming one, but obviously Ambani's Reliance Industries is the largest refiner, and they have been buying Russian oil. So that was the justification for adding those tariffs. Now, one would ask, why doesn't China have those tariffs? Because they buy more Russian oil than India does. But Scott Bessent essentially said India, before the invasion, Russia's invasion of Ukraine, was buying about 1% of its oil needs from Russia. Now he says that's 42%. So clearly there's been a massive ramp up of buying cheaper Indian oil, whereas China's numbers have been fairly, consistent. 13% before the invasion, 16% today, and they, according to Scott Bessent, have diversified their oil imports, not just banking on cheaper Russian oil.
And Steve, of course, this all comes as Wang Yi, the foreign minister of China, meets and has met with Modi over in India. What came out of that meeting?
Well, essentially, they're reaffirming that they are trying to build strength upon strength of their relationship, which has had a rocky history. 5 years ago, they had a border clash. They're going to try and, well, they've agreed to work through those differences and try and make sure that any border disputes in the future do not derail bilateral ties. Now, again, this is all against the backdrop, of course, of increasing pressure, like from what we just heard from Scott Bessent, from the Trump administration on the tariff front. You've seen growing cooperation within the BRICS nations. Also, the SCO, the Shanghai Cooperation Organization, which will be meeting August 31st and September 1st, this time in China, in Tianjin. I will be there bringing you the news. Last time they met was in October, I believe it was, when Modi and Xi last met. So that was right before the election of Donald Trump, but they kind of could tell that the storm clouds of protectionism were potentially going to rise. So they've been trying to build, bridge their differences differences and build strength in the face of those tariffs coming from the Trump administration. So Wang Yi met with, as you can see here, Modi. He met with the internal and external affairs minister, the national security advisors of India. He has now moved on to Kabul, Afghanistan, where there's a trilateral meeting being hosted by the Taliban, and then on to Pakistan, which is a bit of a tricky one as well, because of course that is a historical enemy of India, and so again, India and China have to reconcile their differences over China's engagement with Pakistan.
Yeah, that long-running relationship, of course, with Islamabad. Bloomberg's chief North Asia correspondent, Stephen Engel, thank you for that update. Appreciate it, Steve. Thank you. Coming up, Tesla and BYD have a new global challenger. Xiaomi is looking to sell its first electric vehicle in Europe by 2027. We'll have more on that next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now, Xiaomi is looking to sell its first electric vehicle in Europe by 2027. It is a bid to take on Tesla and BYD globally after gaining traction with its Chinese EV business, which is less than 18 months old. Let's not forget that Xiaomi started off as a smartphone maker. Bloomberg's Asia transport reporter Danny Lee joins us with the details from Hong Kong. Danny, what did Xiaomi have to say about these expansion plans then?
Well, Xiaomi is looking to, it's setting its sights on Europe by 2027. This is all part of its global plan to really conquer many parts of the world with its very affordable, smart EV and, potentially take on the likes of Tesla down the road. Same for BYD as well. So really ramping up the competition, the relative success and over a short period of time it has had in China with its very affordable lineup of models. Wants to take that to Europe, and it believes it can do so in the coming years.
And you talk about Tesla there, Danny. How is Tesla trying to ensure that it can continue to hold that market share in China?
Well, Tesla is taking a twofold approach in China, and let's not forget, Tesla has had a real struggle in sales in many parts of the world, including China. And so it's released a new Model Y, six-seater version, slightly longer than the base model, and it's pricing it to perfection in a market where there's a huge amount of competition, trying to price its new Model Y relative to some of the domestic players. And so by doing so, it tries to give itself a bit of a lift in a very competitive marketplace, but it's still waiting for approval for its some of its like full self-driving products to try and get this driver assistance in the game to really uplift itself against some of the intense competition. But we still have to wait and see when the Chinese authorities will approve that.
OK, let's see if they can. Indeed, price to perfection. Bloomberg's Asia transport reporter Danny Lee, thank you, on Xiaomi and Tesla. Meanwhile, thousands of firefighters switching focus right now, aided by soldiers and water-bombing aircraft, are continuing to tackle wildfires across Spain. The fires have killed 4 people and have burned an area more than twice the size of London. Temperatures have begun to drop, but Spain is still confronting one of its most destructive wildfire seasons in recent decades. Coming up with today's UK CPI report expected to show a tick up in inflation. Is the Bank of England now done with rate cuts for 2025? Sonali Punhani, UK economist at Bank of America, joins me next. This is Bloomberg. Good morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. The global rally stalls as Nvidia leads a tech stock sell-off. Investors look ahead to Jerome Powell's Jackson Hole speech on Friday. Focusing on the future, Europe weighs sending troops to Ukraine as part of a peace agreement, while Switzerland says it will offer Vladimir Putin immunity if it hosts talks on ending the war. Plus, UK inflation in focus with data today expected to show CPI ticking higher, keeping the Bank of England on edge. Let's get to the markets then. And that sell-off in tech was pronounced yesterday. Nvidia dropping 3.5%. The Nasdaq 100 closing lower by 1.4%. And the futures pointing to further losses today. Nasdaq 100 futures pointing lower by 0.5%. In fact, S&P E-minis pointing lower by 0.3. And here in Europe, after a relatively strong session yesterday with gains of 0.6% by the end of the close, looking to fade that today. Pointing lower on the European Stocks 50 futures by 0.6. Here in the UK, the FTSE 100 futures pointing a little lower as well, down by 0.2%. So risk off across these equity markets, at least for now. Let's flip the board and have a look cross asset. Treasuries relatively stable. The pound in focus ahead of that inflation print in a little under 30 minutes. 29 minutes from now, we'll bring you that data. 134 right now on the pound. Softer versus the US dollar by 0.1%. Brent and oil prices are up 0.3% at $66 a barrel. And gold is getting a modest lift after some pressure on the yellow metal, currently up 0.1%. So to the UK, gilt yields rising to their highest in almost 3 months ahead of today's UK inflation data that could cement the case against the Bank of England cutting interest rates again this year. Joining me now is Sonali Punhani, UK economist at Bank of America. Sonali, what are you expecting from the inflation story today and looking through towards the end of the year? How is the inflation story evolving in the UK? What is the stickiness around UK inflation at this point?
Yeah, sure. Hi, everyone. We are expecting inflation to tick up slightly, increase from 3.6 to 3.7. That's still going to be 10 basis points lower than what the Bank of England had in their forecast. So a bit of an increase, but maybe not as much as the Bank of England expected. The kind of components that are going to show an increase are going to be the usual suspects. Services inflation has been sticky for quite a while. So we expect it to tick up again from 4.7 to 4.8. And then also food inflation, which is something that has been, fairly sticky over the last few months. So those are the sort of things that we're going to look out for if we're going to see any upside surprises in any of those components. Clearly, that's something that's going to keep the Bank of England worried. And moving into coming months, inflation is likely to continue to rise. We do expect inflation to go up and sort of reach a peak in September. Our peak number is a bit higher than today, so around 3.7, which is lower than where the Bank of England has their peak at 4. But I think, that's where sort of the risk lies. And I think post-September is when we could start seeing potentially some easing of inflation into the Q4.
OK, so 3.7% is potentially the peak for inflation. That is the view for you and the team at Bank of America. Sonali, what breaks the back of services inflation here in the UK?
Yeah, I think what's been interesting is that, one of the components that explains services inflation is wage growth and the labor market. And if you look at that, there actually we are seeing some encouraging signs. We are seeing that the labor market is easing and there has been some encouraging easing in pay awards. Of course, wage growth still remains fairly high. It's not sustainable with a 2% inflation target, but it's moving in the right direction. And if you look at things like the Bank of England's agent survey, they say that wage growth is something that should tick down closer to 3.5% by the end of the year. Again, still high, but better than where we are today. But what's strange is that sort of wage moderation is not really been seen yet in services prices. And I think some of the reasons is also that there have been one-off factors in the budget that still keep services inflation quite elevated. We did see an increase in vehicle excise duty and water bills, the NICs rise. So all of those factors are keeping inflation sticky. So I think, we need to sort of see these components, work its way through the system and, hopefully going into next year as the labor market continues to ease and growth is weak, we could see some of the labor market, wage pressures, which are moderating, translate to some of the services moderation as well.
OK, but that's more of a 2026 story then. And yes, you and the team still have penciled November, Sonali, for the Bank of England. The Bank of England still goes with another cut in November. That is the forecast from Bank of America. What is your level of confidence in that forecast right now?
Yeah, I mean, I think after the Bank of England meeting that we had in August, we flagged that risk to our November call remains. It's a fairly close call. And I think a lot will depend on, what kind of data comes out in the next few months. I think, the sort of, the message from the Bank of England is that, we've been obviously seeing these quarterly cuts for the last few quarters. Now the path remains much more uncertain, right? It becomes much more data dependent. And what the Bank of England is worried about is this sort of uptick in inflation that we're going to see in coming months having sort of an effect on inflation expectations. So that's something that we have to monitor fairly carefully, though I would say that the bank still thinks that the path of rates is downwards. Their forecasts are based still on 2 more rate cuts. They say that, the rates are still restrictive. So I do think that there are, rate cuts that are, coming. Obviously, the timing of it is more uncertain now. I mean, we still have November as our base case, but, conviction on that is low. And one thing we have to also think about is the fact that we have an autumn budget coming up. We don't really know the date yet, but most expectations are that there's going to be tax rises involved in order to sort of restore the headroom, and that's something that could be sort of negative for growth, which is something that can also support a rate cut going into coming months.
Okay, interesting. Well, on that growth piece, and acknowledging the uncertainty, of course, around that upcoming budget, what is your current assessment in terms of how the growth story for the UK changes through 2026, given that Q2 came in a little stronger than some had expected?
Yeah. No, look, I think the Q2 numbers came stronger than expected, as you said. But if you look at the details of that number, I think they're weaker than what the underlying numbers are suggesting. So the majority of the increase in growth came from government spending, which is, what was sort of supported by the fiscal stimulus that was announced in October's budget last year. So a lot of government spending and also inventories. If you look at private domestic demand, consumption, business investment, that remains fairly weak, and as well as sort of goods exports to the US. So I would think that, the overall underlying trend of the economy is still weak. And going forward, we do, think that, we're going to get trend-like growth levels in the sort of rest of the year, because these tailwinds are there of fiscal stimulus, but at the same time, we have some headwinds from, the Ning story, as well as consumers being fairly cautious and businesses being fairly cautious ahead of tariffs, as well as of the budget. So I think it's a fairly kind of unimpressive story for the second half of the year, sort of trend-like growth. And we have sort of a forecast of 1.2% for this year and about 1.3% for next year.
OK, really smart insights ahead of this inflation data later today, with the expectation that inflation in the UK peaks at 3.7%, growth of maybe 1.2% in 2025, and further cuts for the Bank of England, though timing remains uncertain. Sonali, Punhani, UK economist at Bank of America, thank you. Staying with central banks, but switching focus to the Federal Reserve, where the Governor, Michelle Bowman, has brushed off speculation that she is in the running to succeed Fed Chair Jerome Powell, saying she's focused on her regulatory portfolio. Bloomberg spoke exclusively with the Vice Chair for Supervision ahead of this week's meetings at Jackson Hole.
Well, right now I'm committed to doing the job that I have, and we've really hit the ground running with our request for information on check fraud and other payments fraud, with the SLR proposal that we just put out, the LFI rating system. We're taking a really hard look at our supervisory components and across our reserve banks, as well as at the board, to ensure that we're focused on material financial risk. So I have a big agenda. We're moving through it quickly. Obviously, we need to get the capital proposals completed in the near future. But, I'm really focused on the job that I'm doing, and I'm grateful to the president for appointing me and the Senate for confirming me to this role. So that's what I'm focused on right now.
Well, some Republicans on Capitol Hill have suggested that we should change this three-headed regulatory system and maybe take regulation away from the Fed. What are you telling them, and what do you think the odds of something like that happening are?
Well, I think the most important part is to remember that we have a banking system that's a dual banking system. So we have national banks and we have state chartered banks. And the FDIC and the Federal Reserve oversee those state chartered banks together with the state banking commissions. So I think it's important that we maintain the ability to oversee both the state chartered banks and the OCC with the national banks, and that we have a rational framework that is very similar for all of those banks going forward. So there's not arbitrage between the three regulators. But Congress is obviously responsible for making any changes to that system. So, we'll be working closely with them to ensure that they understand what we're focused on and what we're doing that's supportive of the efforts of all of the agencies together.
So you come out to Jackson, but you also go up to Capitol Hill a lot.
I spent some time on Capitol Hill, absolutely.
Okay, the Fed's Michelle Bowman speaking exclusively with Bloomberg's Michael McKee. To Denmark now. The health of Denmark's economy has been underpinned by Novo Nordisk, its most valuable company. But Novo's recent struggles in the competitive US weight loss market raising some red flags. Shares of Ørsted, Zealand Pharma and Pandora have also taken fairly large hits as well. All of this then having potential impacts across the economy of Denmark. Let's bring in Bloomberg's Copenhagen bureau chief, Sarah Sjolin, for the details on this. Sarah, Danish GDP then expects to take a hit from falls in Novo and some of the other major listed companies, including Ørsted, the wind turbine maker. How sizable could it be? How much of a drag could these companies prove to be for Denmark?
Well, they're definitely going to be a drag on economic growth this year. Before we had the Novo Nordisk profit warning in July, economists were pretty confident we were going to see Danish growth around 3.5% this year. But after they came out and said that their own sales growth was going to be a lot slower than expected, economists are now saying we could see annual growth around 1% in Denmark, even less. So we're coming from a really high point, at least in European standards, and then we're going to, and then it's slowing down. We did see for the first quarter, we also had negative growth for the first time in a long, long time. So we are in a situation right now that if today we get a negative number, which we don't expect, but if we do, we could see Denmark slide into a technical recession. And that's for a country that last year had one of the highest growth rates in all of Europe.
Yeah, so what the projection for growth is 2.5% in 2025, because that does seem otherwise pretty enviable from where we're sitting at least.
Yeah, but we're used to something different, right? We came from 3.5% last year. We have this growth engine of Novo Nordisk. It's this national pride that brings us a lot of jobs. It brings in a lot of revenue. It also brings in a lot of taxes. So for us, it's been this one company that has been shining above everyone else. And now we're seeing that, well, don't get me wrong, they're still performing well. We're still expecting a lot of growth in the company. It's just that we have to manage expectations and bring those a bit down.
Yeah, and certainly the expectations have been managed, haven't they, on Novo, with the stock price down a little over 40% a year to date. How is this tying into consumer confidence? Because, of course, a lot of Danes have exposure, personal exposure to some of these big companies and these major stocks. Is that a factor in terms of consumer confidence and what to expect in terms of the latest data?
Well, it could be. Tomorrow morning, we'll get the consumer confidence for August for Denmark. And all of this stuff with Novo Nordisk, we also had the Ørsted capital raise just last week. It could hit consumer confidence in a way that we're not going to see it in actual data or anyone letting go of their jobs yet. But it's just the feeling that we had Novo shares. They were at a record high, and now they actually pared down 60% from the record high last year. So if you came in on the wrong side of that, you could have potentially lost a lot of maybe unrealized money at this point, but it could hurt people in a way, saying we're not going to go out and buy that new car. We're going to maybe wait until they get a new deck for the house until next year. Because we have seen for a lot of normal Danes, like mom and pop investors, they have used the dividends and the gains from the Novo shares to literally build out their houses.
Yeah, wow, remarkable story. Bloomberg's Copenhagen bureau chief, Sarah Sjolin, thank you for the latest on that front. We look ahead to the consumer data then, the linkages between the feelings, the sentiment amongst Danish consumers and some of those mega cap stocks, of course, like Novo. Now, some of the stories making the news this Wednesday. Bloomberg learning that the private equity owners of Stada Mittal are resuming preparations for a listing of the German drug maker after talks stalled on a potential sale to Capvest partners. Bain Capital and Cinven, which jointly own Stada, have started gearing up to hold an IPO of the business as soon as October. The previous talks were at a valuation of about 10 billion euros, including debt. And Bloomberg understands Intercontinental Exchange, or ICE, will not add EU joint debt to its sovereign bond indexes. It's a blow to the bloc's ambition to attract a larger pool of investors and lower its borrowing costs. It's in a notice to clients seen by Bloomberg, the US firm cited a lack of consensus on how best to classify the issuer. The EU is currently treated as a supranational entity by major index compilers, leaving borrowing costs higher than those of governments with similar credit ratings. And Syrian state media is reporting the country's foreign minister, Saad al-Shaibani, has met with an Israeli delegation in Paris. The two sides reportedly held US-mediated talks focusing on stabilizing the situation in southern Syria. Talks also tackled de-escalating tensions as well as stopping intervention in Syria's domestic affairs. Coming up, we're going to look at whether Senegal can secure new funding from the IMF to stabilise its strained public finances. That is next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. An IMF mission is heading to Senegal to discuss concrete steps to address recent financial data issues. Investors are watching to see if President Faye's administration will get closer to securing the new funding needed to stabilise that country's strained public finances. For more, let's bring in Bloomberg's Jennifer Zabasajja joining me from Johannesburg. Jen, why is this IMF mission so important to Senegal then?
Yeah, Tom, good morning to you. This is an important trip, not just for the Senegalese government. It's also for private creditors and for multilateral lenders alike. Now, this is, as you were alluding to there, really sort of the culmination of what we have seen Africa, one of Africa's the fastest growing economies, really taking a downturn after this unreported data, as you were just alluding to there. That unreported data actually leading to the suspension of the country's $1.8 billion IMF program. And also a subsequent ratings downgrade. And so many people are watching for what this trip then means for the fiscal situation for Senegal, especially as they've at least tried to right the ship over the past few weeks. And it's so much so that we actually have heard from city strategist Luis Costa, who says that Senegal is one of the most indebted sovereigns in their space. And so here's the way that we're looking at it, Tom, from our vantage point. It is important that the IMF and that this mission is engaging with the country. We've heard the country say that talks have been constructive, but the real focus will be on whether or not the country is able to convince investors that they're committed to transparency and that a situation like this, as this full screen is just showing, will not happen again, but then also that they are committed to fiscal stability. And in some cases, that means taking some measures that potentially will not be popular with the electorate, like cutting off subsidies. We've seen that go over not so well in countries like Nigeria and Kenya. And so the question will be, is President Faye's government actually committed to this? And then what does that mean for a potential new program and also for a waiver for about $700 million that was already dispersed to the country? Will they be able to get the approval for that waiver? And then talks will start on whether or not a new program will then happen. And so it's very important to a number of us that are watching this very closely, and also for the stability of a country that many people were saying was on the path to massive growth, a major energy producer and oil producing country in West Africa. So a lot to pay attention to in that sense, Tom.
Jen, just briefly then, how did Senegal get into this mess?
It depends who you speak to, especially the people who I'm speaking to. But really, from the Bloomberg perspective, it started from this audit that we saw from the new government, President Faye's government, which then uncovered, as we were mentioning there, $7 billion of unreported debt from the previous Macky Sall administration. That has, again, led to a ratings downgrade and shot up key fiscal metrics like their debt to GDP ratio, which went up above 100% for 2024. So it's really caused a lot of headache for the government. But Tom, before we go, I just want to note some of the positives that we have seen here, because President Faye and his government have unveiled economic programs. They say that there is an opportunity potentially to renegotiate contracts, oil contracts, and also potentially put more taxes on the electorate, cut off some subsidies, and potentially then they're able to get into a better situation. And President Faye ran on this campaign that he wanted to ease the cost of living and cut out corruption. And so we have seen him at least try to take some legal steps with the previous administration. And so it really has been quite a difficult situation for this new administration. The question will be, where do things go from here? And are they actually able to fulfill a lot of the promises promises that they made in the campaign and also that they're making to investors right now.
OK, watch this space. Bloomberg's Jennifer Zabasaja with the latest on Senegal and that visit by the IMF, that mission by the IMF. Joining us out of Johannesburg, Jen, thank you. There's a lot more coming up. I'm going to preview some of the inflation data expected out of the UK in the next couple of minutes and also give you some colour in terms of the tech sell-off that we saw in the US session yesterday. Stay with us. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. So this was the pain trade yesterday. It was focused on Mag 7 and it was focused on Nvidia. The Nvidia market cap weighting, of course, $4 trillion. And that weighed, of course, on the Nasdaq 100 and weighed on the Mag 7 basket of stocks. That sell-off of around 3.5% from Nvidia and the Nasdaq 100 closing lower by around 1.4%. Is this a valuation concern story? Mag 7, they're trading as a basket. In fact, the Nasdaq 100 is trading at about 27 times forward earnings, 12-month forward earnings. So is it concern about evaluations? Is it some profit taking? Is it hedging around Jay Powell's speech on Friday? The Nvidia story, of course, will give more colour on that next week with the earnings story out of that company. Let's flip the board and have a look at what's happening with Intel, because with that injection of capital coming through from SoftBank, potentially a 10% equity stake coming through from the US government, and suddenly you have valuations, talking of valuations, of Intel at the kind of levels we have not seen since 2002, the dot-com era. You've seen the stock up about 28% in the last month. That has added about $24 billion to the market cap of Intel. It's now trading, at about 53 times projected profits over 12 months. Is that a word of caution, a signal of caution around Intel, as its fortunes seem to have turned around, at least in the last month or so? Let's flip the board and have a look at the preview around inflation out of the UK. Headline July, 3.7% is the number. Core, 3.7% as well. On a headline basis, you're expecting a marginal tick up then from June, 3.7%. The Bank of England is projecting that September you peak at 4% here in the UK on inflation. Of course, markets have faded those bets around the Bank of England. Bank of America telling us earlier they still think the Bank of England can go again in November, though they are cautious now on that timing. That inflation dropping in the next few minutes. Bloomberg terminal users can get these, of course, on the terminal. The opening trade is up next. This is Bloomberg.